So part two of our three-part series is talking about the second basic, which are stocks. So we've talked about budgeting. We're going to talk about stocks now. Bonds are coming. And when we think about stocks, they are basically an opportunity for you to own a piece of a company. All right? So when you buy Apple stock, you own a piece of Apple, and you therefore get to participate in the growth of that company as well as their profits. And it is very exciting and sexy to buy a stock that goes up in value over a long period of time. However, it's equally as difficult to pick that stock and hold on to it and not sell it if it appreciates. And when we think about the stock world, the stock market, there's a lot of fear around that. And the reason that there's fear around it is because many people don't understand how it works. And I'm going to break it down in a way that hopefully will help you understand exactly how it works and how it can work for you. So when we think about the S&P 500, Standard & Poor 500 largest domestic stocks. So what that means is there are 500 of the top companies out there, and there are people who decide exactly which stocks go into that S&P 500 index. From there, that is what is tracked to show you how the stock market is doing on the nightly news or online. The key is it's not always the same 500 companies. And those 500 companies don't always represent the same percentage within that index. And you're saying, well, wait a minute, I'm buying this index. I have a price that I'm paying for that index, and if that index is worth a certain amount of money, what do you mean the companies change? Well, yeah, the same companies have not always been in the S&P 500. Tesla, for example, is in the S&P 500, and they haven't always been there. So what we want to do is understand what that means to us and what the difference is between investing and stock picking. So if you pick a stock and you decide to buy it, in many cases, that could be seen as speculation, right? It could be a speculatory purchase that you are betting that that stock is going to make more money than, say, the other 500 that are in there, all right? So if we were able to buy Amazon in the mid-90s, late 90s, and we were able and strong enough and mentally strong enough to hold on to it until now, we'd be pretty rich. The truth of the matter is that if there's an Amazon that's out there today, we need to know which company it is, we need to buy a ton of it, and then we need to have the fortitude to hold on to it. And many people don't have that insight, that time, or that risk profile to do that. So how do we invest? Well, we invest by broadly diversifying our money to ensure that we have the opportunity to participate in many companies' profits. And companies grow and companies falter at different paces and at different levels from year to year. So recently, we know that the tech industry has done very well. Apple, Microsoft, Amazon, Facebook, Tesla, and now NVIDIA. These are all companies that have become household names due to the rise in their stock price. However, if we have all of our eggs in just that basket, we are taking on substantially more risk than maybe we know. So instead of purchasing just single stocks, we purchase the index, which gives us the appropriate exposure to that stock based on how large they are in relation to the S&P 500. So what does that mean? Well, Apple, for example. If Apple makes up 6% of the entire S&P 500, the only thing I need to do is buy the S&P 500 index, and I automatically have 6.2% exposure to Apple. Okay, well that makes sense. What about the other, 94%, 93.8% of that holding? Well, it's going to be diversified amongst many other companies. And we call that more of a financial plan or strategic investing, because then we know we have exposure to companies that are located in the United States. They're domestic companies. It's the top 500 companies in the United States. And for the most part, their goal is to make money. So instead of putting all of our eggs in one basket or buying one stock, we're buying 500 eggs in one basket. Now, you can buy stocks in the form of an ETF, exchange traded fund, or an index, as we've been talking about thus far. You can hold that position in a retirement account, such as a 401k, IRA, Roth IRA, or you can hold it in a brokerage account. If you buy that S&P 500 in a retirement account, you are paying taxes either before the money goes in or after the money comes out, depending on whether you do so in the form of a traditional purchase or a Roth purchase. Either way, there's no taxation due while you hold that asset, and it's only paid either in the beginning or the end. If you decide to buy that asset, that exchange traded fund, that index fund in a brokerage account does not receive any special tax treatment. Therefore, it's outside of a retirement account. You have the ability to access that asset whenever you want to sell it. However, there could be tax implications upon sale. If you sell that asset for a gain, if you've held it for less than 1 year and 1 day, you will pay short-term capital gains on that asset. Short-term capital gain rates are the exact same rate as your income tax rate. Therefore, if you don't hold it for a long period of time and you make money on it, you will be taxed at your highest tax rate. However, the benefits of investing outside of a retirement account is the ability to receive long-term capital gain treatment. So again, same scenario, you purchase an asset, say the S&P 500 index, and you hold it longer than 1 year and 1 day. Upon sale, if you've made money, you will then receive long-term capital gain treatments. That 1 year, 1 day is the magic mark for you to receive long-term capital gains versus short-term capital gain rates, which line up with your income tax rate. That being said, capital gain rates currently could be 15% or 20%, depending on how much money you earn and what your income tax rate is. So they line up with one another, and then you pay the appropriate rate dependent upon how much income you earned in that given year. If you think about the types of stocks that you can buy and the different types of companies that are out there, there are a variety of types of companies that you can buy. Some are very mature companies and they provide dividends to their shareholders. Others are on a growth trajectory. There are very super giant large companies that fall into this category. There are mid-sized companies, there are small companies, and so forth. And it's up to you to decide where you want to invest your money. In many cases, when you're putting together a long-term strategy for investing, you're trying to get a piece of each of those asset classes in hopes that they do not correlate with one another, meaning that they won't do the same thing if markets go up, markets go down, interest rates change, the environment for investing changes, the environment for companies change. You want those companies to do different things so that you are receiving the appropriate reward for the appropriate risk that you take with each of those diversified purchases. So that being said, when you hear diversification, what it means is that you are investing in different types of companies, different size companies, and potentially even different geographic companies to ensure that your exposure is not all set in one place and that you're getting the benefits of different markets at different times. So investing at the end of the day is really something that allows you to earn a higher rate of return than you otherwise would if you kept your money in cash or you kept your money in a money market account, for example. Over long periods of time, you're going to have the opportunity to participate in company profits and their ability to take risk and make money. By doing so in a fashion that is diversified, strategic, patient, and aligned with when you want to spend that money, it will likely provide you the best result. Whether you do that on your own or you work with a professional, either is fine as long as you know that the decisions you're making are in your best interest and align with your goals.